how to trade the poor man's covered call. And let's talk about this with we're gonna use Soxel because it's something we trade a lot here, and I'm just gonna use it as an example here. So I want to talk about how to trade the poor man's covered call, but I want to talk about it first through understanding the covered call and then the poor man's covered call and then you'll be able to see the differences. Okay. So most of us on the call are accustomed or have heard of or have traded the covered call. The covered call is simply, I'm going to go out with this 7 days here. The covered call is simply having 100 shares and then you sell a call against it. Okay. And it looks something like this. I bought 100 shares down here and I sold a call at the 108 strike. This is what is called a covered call. When you sell a call, you have an obligation to sell shares to the buyer. So if you were selling a naked call, you would have to provide shares to the buyer if they exercise their right. And that's usually done when it's in the money. Kind of marrying this concept, you guys, to the base of options. We talk about the base of options every week. So this is just another way of giving you the basis of options, but doing it through a strategy, the poor man's covered put. But once again, starting with the covered call. We're just going to do it really, really briefly so you can kind of understand. If you sell a call by itself, it's considered a naked call because you do not have shares backing it. But if you have the shares, then it's called a covered call because if you have to live up to your call obligation, the call that you sold, that obligation to sell the shares to the buyer, you already have the shares. When you do a covered call, it's considered more expensive because you have to buy the 100 shares. So for example, down here, it's requiring about $7,200 in buying power, just over that. And to hold the shares, if it was in a cash account or retirement account, you're going to have to basically have $10,000 in your account to do this. A poor man's covered call is when you don't use shares, you use options to supplement or to represent the shares. So normally, if you're doing a poor man's covered call, you're going to buy the call further out in time. So for example, I just say we were doing some type of short-term poor man's covered call. I would buy the call with 25 days from now. And I just say I decided I was going to buy the call in the money at the 70 strike here. Mhm. And then I was going to go back to the 7 days and then sell the call. And then say if I sold it at the same strike at the 708. Well, in this example here, this is why they call it the poor man's covered call, the PMCC, is because I can do that same trade we were just doing for buying the shares that was going to require us, $10,000, up to $10,000 of our account to be able to do the traditional covered call. It's in this poor man's covered call, this is going to require us about $1,200 to do it because that's how much the options are going to cost. Okay. A little under 1,300. Same concept. The option that you buy in the future, later, the further expiration, that is representing your shares because when you buy a call, you have a right to purchase the shares. So you can always get the shares if you want it. So it's covered. It's just cheaper because you don't have to buy the shares initially. You can buy the shares later when it runs up if you decide to do that or not. So it's a poor man's covered call. Most of the time, people never decide to buy the shares. They're just using a kind of synthetic poor man's covered call or synthetic covered call when they're doing this type of covered call. Now, if we go back to the share concept, right? If you buy the shares and you sell the call, that's a covered call. If you sell the shares and sell the put, this is called a covered put. You have the covered call and you have the covered put. Most people never, ever, ever do a covered put. They're not accustomed to that because you have to technically borrow shares from someone. The broker's firm would do this, but technically you're borrowing shares from someone to sell them short, and then you're selling a put, getting some premium from that. But when you sell a put, you have a right to purchase, or excuse me, not a right, you have an obligation to purchase the shares at the strike price. So if it keeps going down, then you're going to have to purchase the share at the 101 strike here. So that's why you're covered at that point. That's why it's called a covered put. Instead of buying the shares and selling the call, this time you're selling the shares and selling the put. A covered put. Now, when you sell shares, you have to once again borrow the shares from someone. The broker's firm is doing this. You don't know who you're borrowing the shares from. And when you borrow shares, you have to pay a dividend on it, might have to pay some interest on it. But people do sell shares to start the trade off. You can see up here that this SOXL is saying hard to borrow. So that means it's not easy to sell the shares short. So instead of selling the shares short and doing a covered put, you can do what is called a poor man's covered put. And that is going out, and I'm going to do this longer term now. Let's say you went out and you decided to go a little bit more than 3 months at this 116 and you buy the put in the money. Say you decided to buy the put at, let's just say, this 60 delta, give or take. Then you decided that, okay, I'm gonna sell a put each week. And so in this case, let's say you decided to sell the put at the 106. So in this example, it's going to require you to have about $6,500 in buying power. I didn't point this out, but the other one was over 10,000, a little over 10,000 to do it. In this example here, you're covered to the downside. You bought the put and you sold the put. Okay. It's going to cost you about $6,500 for the next. And that other one was a shorter term trade. This is over 3 months and it's still requiring less money to do it. And you can sell this put every week to be able to be bearish on something, on an individual underlining, like an individual stock or the overall market. You can be bearish on it doing it this way. And you can limit how much you can lose to the upside. When you do a covered put, you still have unlimited upside risk because you're selling shares and then selling the put. If it goes up, you still have unlimited upside. Just like when you do a covered call, you still have risk all the way to zero still when you do a covered call. Yes, it's less than the person just outright buying shares, just like it's less than the person with just outright selling shares if you're doing the poor man's, or if you're doing the covered put or the poor man's covered put. It's just a twist on the covered call.
Oh, right.
It's
Oh,
just
Brian.
flipping it. Yes, sir.
I looked at the curve view
Mm-hmm.
and it looks like you it's all red to me. And could you go to the curve view on that trade and see where you'll make profit?
So it's not going to give it to you the way you normally would see it on a curve view because it's showing two different expiration periods.
Oh
And
yeah.
so it's not going to give it to you like that. If you did a covered call, I mean a poor man's covered call, it's not going to show you it the correct way either. Um, Gordon, it's because of two different expiration periods. Okay?
Hey, O'Brien.
Yes, sir.
So I actually do this with some not the poor man's covered put, but I do
Hmm.
short shares with some regularity. And just
Hmm.
another note on that hard to borrow.
Hmm.
Hard to borrow means that you're going to pay daily interest. So just keep that in mind when you see those money movement
Hmm.
records in your
Hmm.
ledger, like if you're looking in your history.
Hmm.
So if anybody has ever owned MES or ES contracts outright, not options, but the actual contracts themselves, they get
Hmm.
marked to market at the end of the day. That's when your interest gets calculated as well. So just
Hmm.
some quick and dirty math. The rate is usually around like 3%, 3.5%. So if you have 100 shares short and they're worth $100 a pop, you're going to be
Hmm.
paying about a dollar a day in interest. So just factor that into your trade, especially if it's longer term. If it's a 7 day trade, you're probably going to be targeting more than $7 of profit. But just keep that in mind when you see those money movement records in your ledger.
What
And
happens if you already own the shares?
If
you
you
can't be
own the
short that
shares,
way
you can't.
then.
Yeah,
Okay.
Sorry about that, David.
yeah.
You
You,
had the
you need to be
answer.
able to borrow, Sanjay. So you don't need in that case, you don't have a need to borrow. You would literally just sell a put and try to. You're basically saying to the market, I want to increase my ownership and get more shares by just selling a put.
So when you sell shares, you are bearish, right? And so if you already had the shares, then you either if you try to sell the shares short at that point, it's going to be an offsetting transaction, and so that means your shares are going to be gone, right? So you have to do something else to reflect something bearish, like buying a put, um, or something such as that. If you sell the if you if you if you're already long shares and you sell a put, then you're basically going to long some more because selling a put is what? Bullish. So you have to do something bearish if you already have the shares and you're thinking about being bearish or you're thinking about things going down. Okay. But David, that was awesome. Thank you for pointing that out. That is something I forgot about. I did said earlier that you might have to pay interest, but I haven't shorted shares in quite some time since
It's
my
just weird
fund,
the first time you
and
see it. So
I just forgot about it. But thank
yeah,
you.
if anybody needs help with the math, like I do it pretty regularly. So if you do decide to try this strategy out, feel free to ping me on Discord and I can help you understand what the cost is. It's just so it's annualized. So it's a really simple formula. It's just another thing that you're going to see in your ledger. And you might say if you're short 100 shares of $100 stock, you might wonder like, why am I getting this extra couple dollars, every day, deducted? If the price goes up or down, it doesn't matter. You're paying to rent those shares, to rent the borrowing of those shares.
So what about when it's not hard to borrow? You don't have to pay interest in, but you do
You
have to
don't pay
pay a
interest
dividend,
then.
correct?
Yeah, I suppose that
Okay.
means there's enough liquidity, but
Correct.
I had to do it with my SpaceX shares when I
Uh-huh.
was shorted, when I shorted the day after the IPO.
Hmm.
So I don't, I would have thought there would have been enough liquidity there. That being said, I couldn't actually get a hold of them day one. I could not get them on the day of the IPO. I tried
Hmm.
about 20 or 30 different times during the day, and I was never able to get a transaction to go through. But I got it after the second day, and then I held them for a handful of weeks and paid some interest, and that was it. But
And
yeah,
it
if it's
played
not
it
marked hard to
that was a
borrow, you won't
nice
pay any
trade,
interest.
David. That was a nice trade. That
I
was
was pretty convicted to that one. It was a relatively high
mm,
risk trade, but
mhm.
I had my convictions. Now I'm long on SpaceX. So at this point, I may acquire a few more shares if it
Mhm.
dwindles its way back down toward 100. But I
Mhm.
think at this point, I'm pretty long.
Yeah, yeah, that's a good bet. I think now it sold off really decently, and anything around that 100 price is probably good. Even though if it drops below that, I think that's a good level.
Yeah, you get $100 SpaceX shares. Like I consider holding those very long term.
Yeah, see if it turns into gold like Tesla did for a lot of people. Yeah. So, so just to wrap this up, you guys, the poor man's covered call is a cheaper way to doing a traditional covered call of buying shares and selling the call. It's going to require more capital. That's why they call it the poor man's covered call. The covered put also requires additional capital. Even though what's happening is that they actually put monies into your account when you sell. Just like when we're selling options, money's coming into your cash. And so if you sell $100 a share company and you sell it at $100 and you sell 100, you obviously 100 shares, you're going to have $10,000 put into your account in your cash. But you're still going to have some buying power to hold that, because you are, selling shares that most of the time things go up. So you're going to have some buying power to do it. Just like if you were going to be buying the shares, you're going to have some money to do it. Now, when you sell the put against your shares, that's a covered put, right? Because selling shares is bearish, selling shares is bearish, selling the put is bullish. So it's going to be a limit to what you can make to the downside, because the bullish selling of the put is going to offset the short bearish shares. Now, that's going to require a little bit more capital to do that, and it can require interest, like David just stated, and it can require you to pay the dividend if you still short shares, and the dividend is paid on the underlining that you're doing it on, right? Because you're technically borrowing the shares from someone. You don't know who it is. The firm's going to take care of that, but you're technically borrowing shares from someone. When you close the position, you're buying back the shares. You're closing it by buying back, just like if we were selling an option, we're buying back something. But with the shares, you're buying back the shares, and then you're returning the shares back to the owner. Once again, you don't know who the owner is going to be. Okay. That's going to be a little bit more capital, but you can mimic that. You can do that same kind of concept by doing a poor man's covered put. You can buy a put further out in time, and you can sell a put closer in time, closer to expiration. And that will form the poor man's covered put. Less risk, because your risk is defined that way. It's defined, meaning that the most you can lose is what you originally paid for the poor man's covered put. That's not the case with the covered put. I know this is kind of sounding confusing, but you'll get it once you listen to this recording again, and once I open it up now for more questions. So let's do that now. So I think I see Sanjay first and then Todd. Go ahead, Sanjay.
So effectively, if you short the shares and then you sell the put, are you trying to reduce that deficit? Because you're short the shares, and when you sell a put, you're effectively agreeing to buy the shares. So I'm not understanding, how are you profiting by selling the put?
So are you talking about the poor man's covered call or the covered put? Which one are you talking about?
The poor man's covered put.
Okay, so you profit. So here's me reverse the question, Sanjay, because then you and others will understand a little better. So if you buy a put, going back to the basics, what do you want it to do when you buy a put?
You want it to go down. You're bearish.
Okay, absolutely. So if you sell a put, what do you want it to do?
Well, I guess it depends. If you want to own the shares, then you're bearish.
So
but
just a put period. If you sell a put, just what
you're
is that
bullish.
to do?
You're
Exactly,
bullish.
exactly. If you sell a put, you're bullish. So
Right.
so what's happening, the way it looks like this, then Sanjay and everyone on the call, it looks like this, but in different expiration periods. But it looks like this. The poor man's covered put looks like this. And so what is this right here, Sanjay, that I have on my screen right now? What kind of strategy is this?
It's a debit
Yeah, but what type of strategy is it though?
spread, put spread. It's a debit put spread.
Exactly, exactly. And so, but not but if you're doing a debit put spread, you want it to go down, right? And the most you can make is in between this here, okay, minus what you
Right.
paid, right? Well,
Yeah.
that's the same if we switch this up and we put this call, instead of this put instead of 7 days away, let's say we put it, I'm just going to use this because it's right here, 30 days away, right? And
Yeah.
we did something like this. Well, it's we still want it to go down, and how we profit is how if it goes down. That's make a long story, make a
Right. And then you're selling the shorter term. Okay. It's kind of
exactly.
mimics the PMCC in that
Exactly, a
respect.
hundred
Okay.
percent, 100%. You still want it to go down with this
Got it.
trade, and if it goes down, that's how you can win. But if it goes down too fast, then you're gonna obviously limit how much you can make to the downside. But you want it to go down. As you can see here, these deltas are negative.
Right.
Okay, that's how you win. And then and in this case, what you're going to be doing is that you just have to do the opposite of the trade to close it. Right. So the one you sold,
Yes.
you have
Yeah.
to buy back.
Buy it
The one
back.
you purchase, you have to sell back. And then you're out of the trade, and you benefit, you profit the difference, right? Or you lose the difference, whichever happens. But if it goes down, you're going to win. Okay.
Got it.
If it goes down enough, you're gonna win. And because the poor man's covered put is usually you're buying the put usually 90 plus days out. You're letting it play out. You're not gonna normally you don't do poor man's covered puts or poor man covered calls shorter dated time with the long leg because you're trying to let it play out. You're trying to set it up like synthetic stock, right? Like synthetic shares. So you need to let it play out. All right, so Todd, you're up, my friend.
Okay, good morning.
Hey, good morning,
The
Todd.
my question is along the lines of what David was saying.
Uh-huh.
With this strategy, what happens if your intention was just to take ownership of the share and then you just traditionally go into the safeguard strategy? Is there like more fees if you take ownership once the shares are assigned, or
So if you're selling a put and your shares are assigned, then no, it's no additional fees for that besides the
okay?
normal type of stuff that you're accustomed to for, you know, executing the put and the shares, right? So,
Yeah.
but that's different than what we're saying right now.
Oh
Um,
yeah, I know. I know.
Okay,
I
okay,
just
perfect. You
yeah,
just wanted to
I
make sure
understand
you
that part.
wasn't paying
Yeah.
interest on the stuff you already, yeah, no, no,
Right.
you're not. You're not.
Okay.
Once you sell a put, the only fees you're paying when you sell the put is the commissions and the fees, right? That we're accustomed to. And then once you assign the shares, your brokerage firm might charge you something for being assigned, right? I know Thinkorswim doesn't. I think Chasey Trade charges you a little something of being assigned the shares. But after that, you're not paying any interest or anything like that, because you have the shares. Those are your shares. But someone might pay you interest. You might see some interest in your account if someone borrowed your shares, if the brokerage firm picked you to borrow the shares from.
Okay. Okay.
Okay.
Thank you, Brian. That answers my question.
Brian?
Okay.
Oh, Brian.
Yes, sir.
What would be your calculation on whether to use, say, 60-day for a long versus using a leap? Because the leap would be more expensive, but the decay is better, right? It's more minimal.
So for for me, it all depends on my assumption, Devin, of what do I think the do I think my opinion of what is going to happen is going to happen within, a 60, 90, 200, 300, 365 day period. And then that's how I would determine how I would do it. And so most of the time you want to give yourself enough time. So at least, in my opinion, at least 90 days, but most of the time it's going to be more than that. Most people do poor man covered calls, or poor man covered puts like 6 months or more out. So it can give you the time for it to play out. And if it doesn't play out, if it kind of stays in the range, the put in this case that you're selling each time is lowering the overall cost into the point that it can take it all away if it did nothing, if that makes sense. Okay.
Are you also looking at the premium you're getting for the short put in
So
this
absolutely,
case?
each week that you do it, or each month that you do it. Yes. So
And
if you originally paid, I just say, $1,000 for the overall trade, and you can sell something $100 every week. Well, that's 10 weeks that goes by, and you can potentially pay off all what you originally paid, right? So that's why you're selling something against it.
yeah, I'm just wondering if maybe the return is better on a leap versus the 90-day or 60-day or
Well,
something.
um it could be, but that all depends on what type of move it might have, what happens, right?
Yeah,
So that's really a real big depend, right?
yeah,
So
yeah, yeah. Okay,
so
very good.
so
Thanks.
Swati, sorry about that, Devin. Swati had her hand raised before you jumped in, so I thought you were going to be asking a question exactly what Todd was. But I'm going to come back to you, Devin, just to check with you. But I'm going to go to Swati now.
Brian, so every week when you sell short the short puts, right?
Hmm.
If it goes in the money, you just roll it to the next week, um, for again at the ATM to try and maximize your profit, correct? And you keep
So that's
rolling.
definitely one way you can do it. 100% you can do it that way. Just like you would do with the covered call or
Uh-huh.
the poor man's covered call, you can do that with the put as well. And so
Mhm.
what Swati is saying, I know it's a little hard to hear you, Swati, but I heard you. Um,
Oh,
what what Swati is saying is that, let's say we had a Sox L trade on like this, and I just say it was I'm just picking one day, you guys. And I just say the put that we sold was, like this. But what we can do is buy that put and look, and this is one day. It's a lot of extrinsic still in here, but let's just say we buy the put. It's an 87, it's an 86 delta, and then we go out 7 days, for example, and we decide we're going to sell it back at the money, something like this. Well, that the difference in that is a bunch of extrinsic, and so that is what is going to be lowering our cost basis here. This right here. So yes, you can do that. And stock sale is obviously a different beast, right? Look at how much premium it's giving you at the money right now.
Oh, this is SP. This is Soxal or SPX?
Oh, I'm sorry. I'm sorry. I was thinking I was still looking at stock sale. That's why that premium was ridiculous. Thank you, Jaswinda. Oh
so
boy.
I just O'Brien wanted to discuss if it
Mhm.
goes in the money, you
Mhm.
roll it to the next ATM, sometimes take a profit and sometimes take a loss. Um, every week, correct? So if it is 6 months out, you have 6 months of profits and losses, and you're betting that you come out profitable in the end.
That is correct. And your extrinsic should be a profit each week. You're going to be paying debits and things like that sometime to roll, right? When what you're talking about right now, but the extrinsic should be good each week. So, for example, let's just say, let me show this with stock sale. 2 days ago, let's just say that your trade is like this. I'm just picking 85 delta, for example. We're buying, that is that's the put that we are buying back that was sold. And we go out 7 days, and let's say we sell this at the money here, right there. Okay. Well, this is a debit of 500 and something, right?
Mm-hmm.
But if all of that extrinsic comes out, you're still going to be fine if it did nothing. If it just stayed where it's at, you're still going to make, I just say $100, give or take. Okay.
Yep.
And so each week that you're selling it, yeah, you're sometimes it's going to be a net credit plus extrinsic. Sometimes it's going to be a debit and just the extrinsic. But if it's a debit and it does nothing, and the extrinsic could supersede that debit that you paid if it does nothing. If that makes sense. Okay.
Yes, it does.
Okay.
Yep.
All right. So anyone else with any other questions this morning regarding this? I know this is the first time we talked about the poor man's covered put in a long time, but I know Gordon is asking a lot of times when we did poor man's covered calls in the past, can you flip these kind of things? And yes, you can flip it. And it could be a really good way to kind of offset some of the risks in your overall portfolio, define kind of concept of doing a poor man's covered put to kind of offset some of the risks in your overall portfolio. If you did that, the 0DT trade, you guys, we just got out of it. So that was nice. So we played that well. And so we'll take that. So good short-term trading recently. All right. So you guys,
So
go ahead.
if you were setting up a poor man's covered call on Soxel, let's say you go 116 days out or 144 days out, how would you set up what
set it up?
strike would you use?
So for a lot of times you can do it. Some people like doing it at the money, like Awanza's because it's cheaper. Some people like doing it in the money, the call part. And so with Soxel, I would probably, if I did it, I would probably go no higher than a 60 because it's somewhat expensive, but that's $8,400. And then if I was going to do this on a weekly basis, and I just say I sold the put at a little lower, let's just say right here, the 105. Well, that's going to require me $7,700, right? And so if I take, and I just say I received about $500. It's more than that, but let's say I received $500 for selling the put every week. So if I take the 7,700 divided by 500, it's going to be 15 weeks, and that it would take me to pay for this whole thing without any appreciation. If I can sell $500 each week, it'll take me 15 weeks to do it, right? And so how many weeks are in 144? So divided by 7 is 20 weeks, a little over 20 weeks in 144 days. So you can get all your monies back plus some just by selling something against your thing every week for about $500.
Thank you.
Not including getting any of the directional play for yourself, right? And this can be the same kind of concept with the poor man's covered call. Right now, I'm obviously showing the poor man's covered put.
So Brian, you would close out the 104 and then get back in the next week. Is that
every week. And so what would determine closing this out is if it's a high delta, like 85 or higher, and how much extrinsic is still in it, but they just say delta wise 85 or higher. Usually you're going to be doing it between 85 and let's say 95. You're just going to roll it back to at the money the following week. Or it's a low delta, right? There's nothing left in the trade. Let me just show you something like this. Let's just say we had it was 2 days ago and my put was like this. This is the short put. Well, maybe at that point I just buy it back. And then in this case, I go out 7 days, move it back to the 107. I mean, at the money here, which is the 107, I just say, and boom. Now this is what we were talking about earlier, Swati, is that now you're getting the credit, and the credit obviously represents the extrinsic as well in this case. Okay.
Yep, makes sense.
And so it's just keep each week collecting more premium and just slowly trying to lower your cost basis. If it's doing nothing or if it's moving, you're still trying to sell stuff against it each week. Okay. All right. So you don't have to do it at the money, right? It's just like, just like if you can get the most extrinsic there, but if you wanted to do it a little out of the money, something like this, you can. That means you can make this credit here, plus you can make the appreciation if it keeps dropping. All right. So you guys, I'm all out of time this morning, but we will be back at it this afternoon with the witching hour. And as I pointed out earlier, we have the Monday night group classroom with Gustavo tonight as well. So just want to make sure you know the schedule. But I will see everyone back this afternoon at 3 p.m. Eastern. But otherwise, thanks for all the interaction. And it was a good, I think it was a good class. So I appreciate it, you guys. Bye for now.